Welcome to my channel. I'm Scott, and in this video I am going to walk you through the process of valuing Nutrien stock by analyzing their financial statements and dissecting their financial ratios so we can determine if it's a buy or a sell. Nutrien produces potash. 95% of potash is used in fertilizers to support plant growth, increase crop yield, and preserve water. It is also used in manufacturing potassium-based chemicals for things like detergents and ceramics. This company is the largest producer of potash and the third largest producer of nitrogen fertilizer in the world. They have 1,500 retail stores, and they were formed through the merger of Potash Corp and Agrium. The company is headquartered in Saskatoon, Saskatchewan, Canada, and was founded in 2018. The ticker trades on the New York Stock Exchange, Deutsche Börse, Mexican Bolsa, TSX, and London Stock Exchange. Let's get started with the model. This is a large cap company, 48 billion market cap. They're trading at 86 a share, and they have 554 million shares outstanding. Let's look at their financials. The way you value a company is you estimate the free cash flows into the future, and then you discount those numbers back to today's value. That's what we're doing in this video. And free cash flow is cash flow from operations minus capital expenditures. Their free cash flow is pretty consistent year to year. 1.8 billion up to 2.1 billion. Net income is the profit or loss on the income statement. It's revenue minus expenses. And that grows a lot from 1 billion up to 4.4 billion. Revenue is the sales for the company, and that grows nicely from 20 billion to almost 31 billion. This is the company's income statement. The top line is the revenue, the sales. Below that is the cost of revenue. These are the expenses directly related to generating the revenue. Revenue minus cost of revenue gives you your gross profit, and that grew from 5.4 billion to 11.5 billion. Their gross margins are also improving a lot, from 27% up to almost 38%. Gross margin is the percent of revenue you turn into gross profit. So 38% of their revenue, they converted to gross profit. Below that is their operating expenses. These are all the expenses not directly related to generating the revenue. Gross profit minus operating expenses gives you your operating income, and that grew a lot from 2 billion to almost 7 billion. Their operating margins more than doubled from 10.5% to 22%. Operating margin is operating profit over revenue. They spend about $500 million of interest on their debt each year. Then you have other income and expenses. These are all the gains or losses not part of the company's core operations. Your pre-tax income, your taxes, and the bottom line of the income statement is your net income. And their net income grew a lot, more than 4x from 1 billion to 4.4 billion. Did you ever notice the further down you get on the income statement, the more exaggerated the growth is? Their revenue grew 50% from 2019 to the trailing 12 months. Their gross profit grew more than 100% from 2019 to the trailing 12 months. Their operating income grew about 250% from 2019 to the trailing 12 months. And their net income grew 350% from 2019 to the trailing 12 months. If a company reports negative net income, this doesn't work. It only works for companies that have positive numbers. This is the company's statement of cash flows. The top line is operating cash flow. That's how much cash the company generates from its operational business. You could think of operating cash flow as net income converted to cash, because net income is your accounting profit or loss. It's not actual cash. They spend a good amount on CapEx each year, 1.9 billion in the trailing 12 months. These are investments in property, plant, and equipment. Operating cash flow minus CapEx gives you your free cash flow. They average about 2 billion a year in free cash flow. They do pay a dividend with the free cash flow. They also buy back stock. They bought back 1.9 billion in 2019, 160 million in 2020, and 1 billion in 2021. When a company buys back common stock, that decreases the shares outstanding and makes your shares more valuable. They also paid down a lot of debt in 2021, 2.5 billion. But they added 700 million of debt in 2020 and 300 million in 2019. Let's look at the capital structure. 24 billion of equity, 12 billion of debt. They're 67% equity, 33% debt. And I gave them middle whack on Finbox, 9.3%, and that's a discount rate we're going to apply to the future cash flows. We estimated 4 years of future free cash flows. We also estimated a terminal value, which is all cash flows past year 4, that's $31 billion. We discounted those numbers back to today using the weighted average cost of capital. We get a value of the company of $30 billion. We divide that by 554 million shares, and we get a calculated stock price of $54. They're trading at 86. So they're trading at a 60% premium. It's a sell according to the model. Their revenue target in 2024 is $31 billion. In 2023 it's $35 billion. In 2022 it's $40 billion. And I continue this trend into 2025 and I got $26 billion. That's how I got their future revenue estimates. They convert on average 8% of their revenue into free cash flow, so I multiplied their future revenue estimates by 8%. That's how I got their future free cash flows. The website Simply Wall Street values the company at 174. They're saying the stock is 50.4% undervalued. 14 analysts price this stock and the average price target is 119. The low is 98, the high is 135. This is where the stock has been trading the last 5 years. Before mid-2021, it hardly got above $60. But then the stock price shot up to about 120. It has regressed in the past few weeks, like most stocks have. It's down to $87. This bottom chart is the price of potash the last 5 years. You can see there's lots of similarities. Their stock price started increasing in mid-2020, and potash was pretty flat until the beginning of 2022. Then it really shot up. So generally, if the price of potash goes up a lot, so will the stock price. And if the price goes down, so will the stock price. They pay a quarterly dividend. It grew from 40 cents up to 48 cents. That's a yield of 2.2%, which is 24% of their net income, 51% of their free cash flow. The next dividend will be paid on July 15th. So you have to own the stock on June 28th or before to get that dividend payment. Their yield peaked at 5% in the beginning of 2020. Then the yield came down a lot because the stock price increased so much. And the forecast is for the yield to be 2.3% by 2024. About 4 million shares are traded each day on this stock. Almost all the shares outstanding are on float. 69% are held by institutions, and 1% of the shares are shorted. They have a beta of 0.81, so the stock is less volatile than the market. It's gone up 36% in the past 52 weeks, while the S&P is down 8%. The 52-week low is 57, the high is 117. And the stock is trading between its 50-day and 200-day moving average. If you invested $10,000 into this company 10 years ago, you'd have $18,000 today. That's an 83% return, a 15% annual return. The CEO's salary is $676,000 and their total compensation package is $4.2 million. Here's all the insider buys and sells in the past 12 months. There were a bunch of buys in 2021, but lots of sells in 2022. I guess people are taking advantage of the high stock price. 67% of the company is held by institutions, 33% by the general public, and a small percent by private companies and insiders. Their employee count shot up a lot in 2018 from the merger. They're currently at 23,500 employees. The biggest shareholder is Fidelity at 4.5%, then Vanguard, RBC, Fidelity, another division of RBC, BMO, McKinsey Financial, Dodge & Cox, TD, and Managed Account Advisors. Let's look at their financial ratios. They have a really good PE of 10.8, that's stock price over earnings per share. A good price to sales of 1.6, price to book of 2.0, and their price to free cash flow is 23, that's stock price over free cash flow per share. Their return on invested capital is 15%. They can cover their interest payments 14 times. ROE of 18%. Current ratio of 1.1. That's current assets over current liabilities. It looks like they have lots of inventory. Their quick ratio is 0.5. They generated $2 billion of free cash flow in the trailing 12 months. They have $2 billion of working capital, and they paid out $1 billion of dividend payments. So it looks like the company's pretty well capitalized. The best way to look at ratios is to compare them to companies in the same industry. There are 18 companies in the same industry as Nutrien. And if Nutrien has a number in red, they're worse than the average. If they have a number in blue, they're better than the average. So they're pretty much better than average in every single category. They spend more on CapEx than any other company. They have a good debt to equity ratio. Their dividend yield is higher than average. They generate lots of free cash flow. They're the largest company on this list. They have a good price to book, a really good price to earnings relative to average, a good price to free cash flow, also a really good price to sales relative to average. They generate the most revenue of all the companies. So to summarize, I have them trading at a 60% premium. It's probably best to buy this stock when potash is low. But you saw on that chart earlier, potash was pretty much flat and low for a really long time. So your stock would have been flat. Unless you own this stock or any fertilizer stock in the beginning of 2022, you would have had a great return. So it's really a timing game. I ranked their free cash flow 7 out of 10, their revenue 8 out of 10, and the ratio is 8 out of 10. So let me know what you think. Give this video a like, subscribe, or comment below. Also, if you'd like to get a custom valuation or just support the channel, you can become a member by clicking on the link in the description below. Thanks for watching.